What if I told you the biggest disruption in finance isn't crypto or central bank digital currencies? It's automation. Because AI isn't just making finance smarter, it's making entire layers of the financial system unnecessary. Your bank is a middleman, and AI is removing it. For decades, finance has been powered by middlemen: banks, brokers, clearinghouses, payment processors. They don't just move money, they charge fees for friction. But AI is turning friction into software, and software doesn't need permission. This is part 6, the end of middlemen. Middlemen exist because finance is complicated. Someone has to verify who you are. Someone has to decide if you're risky. Someone has to approve transactions, prevent fraud, and track compliance. But here's the key idea. Most of that work is pattern recognition. And pattern recognition is exactly what AI does best. AI doesn't wake up and replace a banker overnight. It replaces the steps a banker used to do. Think about fraud detection in real time, credit scoring in seconds, or automated underwriting. It handles compliance monitoring and flags risks before humans even notice. And once those processes are automated, the cost of running finance drops dramatically. That's where the disruption really begins. Traditional payments are full of invisible stops: authorization, clearing, settlement, multiple parties all taking a cut. AI helps remove that friction by detecting fraud instantly, verifying identity automatically, and routing payments efficiently. It even reduces disputes and chargebacks. In a world of instant intelligent payments, the middle layers get thinner, and the thinner they get, the less power they have. Payments are becoming instant, and fees are collapsing. Lending used to be slow because it relied on static documents, payslips, bank statements, and credit history. But AI can evaluate risk using live signals like income patterns, spending behavior, business cash flow, and even real-time risk alerts. That means faster approvals, personalized rates, fewer defaults, less human labor, and lower costs. And here is what that implies. You don't need massive lending departments to scale lending anymore. You need models, data, and oversight. Loans are becoming real-time decisions. In investing, middlemen have historically controlled access. You needed brokers, funds, and advisors, gatekeepers. But AI makes portfolio tasks automatic. Risk profiling, asset allocation, rebalancing, tax efficiency, and scenario simulation. This doesn't mean humans are finished. It means the old value, placing trades and selecting products, is becoming less valuable than strategy, behavior, and risk control. We're moving from advisors to algorithms. Here's the part most people miss. When finance becomes automated, control becomes automated too. AI can block transactions instantly, flag accounts automatically, restrict spending patterns, and enforce rules without human judgment. Supporters call it safety and efficiency. Critics call it financial control at scale. So the future isn't just about faster finance. It's a question of who owns the rails and who sets the rules. The end of middlemen doesn't happen with an explosion. It happens quietly as fees shrink, approvals speed up, and systems go fully automated. The future of wealth belongs to people who understand how money moves, how rules are enforced, and where power actually sits. The winners will understand the system, not just the hype. If you want part 7, where we expose the new middlemen replacing the old ones, like, subscribe, and comment part 7. Because in finance, the biggest changes happen before most people notice. Thanks for watching.